Hello and welcome everyone. In this session, we're going to talk about the Personal Tax Financial Act 2025, and this exam will cover from January 2026 to January 27. So let's walk through this question, the practice assessment one from the AAT website. So let's take a look. So the instruction will be same for every single exam. So if you already have done some exam, you know how it work. Otherwise, you can quickly read. This information is always available on the AAT website and also before the exam. So the exam will be 2.5 hour personal tax. You need to complete 10 questions in the exam. So 10 tasks for 2.5 hours. All right, so let's start. So the first question will be the theoretical question. So that will be for the 10 marks. And this question is a very important because that will be the only theoretical question. So you don't have to do any calculation. You just need to write everything in this question. So I always recommend to the student to make sure like you try to memorize this question rather than you just try to make up the answer. So for example, let's say if we have, for example, the question for tax evasion or tax avoidance or tax planning. So all you have to do, you have to just write it down. Now let's take a look at the first question. This question will be divided into two sections. So you have a section A and B will have two parts. So you can see B1 and B2. So the first one, they're asking state and define any three of the five principles. So there are five principles which underpin the taxation system. Now, again, as I said to you, you have to memorize it. And there is nothing like you need to understand. Just need to memorize the definition and you need to write five principles. So if they're asking you three, you write three. If they're asking five, you write five. There's five principles. All you have to do just to memorize the definition. So let's try to write all the five definition here. So I have write it down now. So you can see here, they state three of the five principle. I have write it on all five principle. All you have to memorize it. And this question have nothing to understand. So let's take a look. The first one is neutrality. This is defined as allowing equitability between the different form of business. Efficiency, this is defined as minimizing the cost. Then certainty and simplicity, this is defined as making the tax rules clear and simple to understand. Effectiveness and fairness, this is defined taxation being right amount and right time, and flexibility, so easy to communicate with the technological factor. Now, of course, like this one is not very common in the exam. So the common one in the exam, this type of question is more likely the tax evasion, the tax planning, and the tax avoidance. So this question is very common. Also, there are another three definitions that was for the progressive tax. There is one for the regressive tax, and one is for the neutral tax. So you need to make sure you have revised all of this, not only this one. So make sure you revise the progressive tax, regressive tax, and the neutrality of the tax, and also at the same time the tax avoidance and tax planning and the tax avoidance, the tax planning and the tax avoidance and tax evasion. So which one is legal, which one is illegal? That one is more common in the exam. At the same time, you can read this one as well, the five principle that is underpinning the taxation system. So make sure you memorize it. So this one have nothing to understand. As soon as you see this question in the exam, just write like a copy paste. That's how you can save some time and you can use this time for the next question. All right, so next one we have here, this one is saying like about the WWD, that is worldwide disclosure. So this one is kind of the new thing introduced by the HMRC, even though it is like quite old. It's been quite many years HMRC introduced this law. For example, if you have an income, for example, overseas, let's say you live in UK, you are the resident of UK and you have some property in Spain and you have some property on your back home and you have a rental income and some other income. So do you have to disclose this income in UK? The question is yes. If you are a resident of the UK, even though you are not bringing any money from the overseas country. For example, you have some rental income in Spain, but you are not bringing that income in UK. But because you are the resident of UK, you have to declare it in the UK. This is called WWD, Worldwide Disclosure. Right now, more than 100 of countries, they are sharing their data. For example, all the Europe and Australia, USA, they're sharing their data internally. For example, even if you do not tell HMRC that you have a property in Spain or Portugal, they will find it. They will have the information because the Portugal authority or the Spain authority, they share the information with the UK HMRC. So HMRC will send you a letter and say like, oh, we found you have a property in Portugal or you have a property in Spain. Can you tell us like about that and can you declare it? Otherwise, we can give you a fine. So you need to make sure you declare it. This is called WWD, Worldwide Disclosure. You can search on the Google and it will give you the whole story how it works. But for the time being, the question will ask you for the AAT like any UK resident, do they have to declare the income in the UK? The answer is yes. If you're a resident, now how we do the residency test, you will learn it on your different chapters when you study the level 4 AAT personal tax. So you know the resident definition. If you live in the UK more than 180 days, you're a resident. If you have a tie, 5 tie, how does it work? You already know it by this time when you're doing the revision. So here the question will be very simple. So they might ask you a little bit more for the residency test. So you need to make sure you remember the residency test as well. So here the question said, you work in accountancy firm and you have a client who is a resident in the UK. So you really don't have to prove this client is a UK resident or not, because the question already tell you this client is a UK resident. The client has always declared all UK income to HMRC. He has started receiving rental income from an overseas property. The client has emailed you stating that as the property is not based on the UK, he does not need to declare this income to HMRC. So the client is believing because the income is not in the UK, he do not have to declare it to HMRC. Now, what will be your reply? So your reply will be state why the income from the overseas property needs to be declared. So the question already asking you why even the income is not from the UK, you have to declare in the UK. So you need to say as the client is UK resident, he is liable to declare all worldwide income and gain in the UK. So overseas income or any worldwide income and gain he need to declare in the UK. Now, this rules is not explained in the AAT syllabus in detail because this one is quite long rules we need to learn if you want to understand everything about how the worldwide disclosure work. For example, there is something called remittance basis. So if you bring the money, for example, from overseas to UK, how much you can bring. For example, up to £2,000, if you bring under the remittance basis, you do not have to pay the tax. So there is a different rules, but AAT syllabus do not cover all of this. In future, if you study ACC or ICW, you're going to learn a lot of rules about WWD. But for the time being, all you have to remember, if you are a resident of the UK, even if you are deemed resident, or if you are, for example, deemed domicile, you need to disclose every single income you have, not only in the UK, but overseas. That's all you have to know for the time being. All right, then here the question said the client does not want to declare. Now, the next one it says explain your actions if the client refused to make this decision. So you said, oh, you have to declare it, but the client said, no, I'm not bringing the money to the UK, or this income is not relevant to the UK, so I do not want to disclose it to the HMRC. So what will be your action? Remember that only 4 action as an accountant you can take in every situation, not only in this situation. Every situation we're going to take this 4 action. What is the 4 action? First action is I will tell the client, sorry, I cannot act as an agent for you anymore because you are not listening to me. So I will tell you the rules, but you are saying, no, you don't want to declare. So if you do not declare from now, I will not be your accountant. That means as an accountant, I am your agent and you are the principal. So that means from now, I will not be your agent anymore. So I will tell you that first. So I'll tell the client first, I'm not going to be agent for your agent anymore. And at the same time, I'm going to inform HMRC. I'll tell like, from today, I'm not acting as an agent for this client. Now, it's look like it's a complicated process, but to be honest, in real life, it's quite easy. So for example, if you are an agent, you are an accountant, you have a HMRC service account. So you have an agent login. So you log into the HMRC account and you just remove the client. So you just click like if you have a friend on Facebook, the way you delete it, exactly same way you just click. and then it will be gone. So there is nothing like you need to write an email to HMRC, write a letter. No, it's just like a 1-minute job. You remove the client, and HMRC understand like from today you are not agent for this client anymore. So that's it. Once you've done this one, the next thing you need to make sure you do not give a reason to HMRC. You do not tell HMRC like, oh, I tell the client to declare, but he is not willing to declare. For that reason, I am not acting, or I am ceasing my action. You are not allowed to do that. Just say from now, just remove yourself as an accountant from today because the client is not listening, but do not give a reason why. So never give a reason. Otherwise, it will be the break of confidentiality. You cannot give a reason for that. This is number 2. So I'm acting as an agent, and I'm telling HMRC I'm not agent anymore. And the next thing, I'm not giving any reason. So do not provide any reason to HMRC for that. And the fourth one is make sure you have a written communication. That means every time you give any advice to the client, make sure you give in written so that the client cannot sue you. The client cannot tell like, oh, the accountant didn't tell me that. So the client cannot tell HMRC later on like, oh, I wanted to declare, but no one told me. My accountant never told me. So you need to make sure all the communication with the client has to be written. So this is our action. Remember that this is not only the case for the WWD, worldwide disclosure. Any situation, if the client do not agree, for example, if the client do not like to pay the tax, if the client do not agree, any advice we give, we stop acting as an agent for this client. Do not give the reason and communication written. That's all. 3 marks, 3 line, 3 sentence, more than enough. So that's all for our first question. More or less, if you remember the definition, you will get the full marks here. But this question, 10 marks, try to do it as fast as possible. Do not spend too much time for this question. It's theory. If you don't know the answer, just skip it, move on to the next question, because other question will be more likely you know. But this question, sometimes either you know or you don't know. So if you don't know, don't try to make the answer, because it's not going to be helpful. If you have time, you can always come back. All right, let's move to the next question. The next question you're going to move here, task 2 for 14 marks. And this task is about the benefit in kind. So this one is very important. This question will be 100% in the exam, the car benefit. So you need to make sure you are happy with that. And most important thing here is the reference material. Make sure you get used to the reference material. So you need to make sure you know how the reference material works. For example, the car benefit percentage is here. So you need to make sure you don't have to remember it because it will be on the exam. So you need to just get used to with this reference material. So in the exam, you don't look for like, oh, where is what? So you need to do enough practice. So in the exam, you know, like click, where I can find what percentage. So here, let's read the question first. The question is said, this task is about income from the employment. This task contains part A to C. Dr. D and Ms. B had the use of the company car using 2025 and 26. All necessary information in respect of each car is detailed below. So Dr. D and Ms. B. So some information are really important. So we need to make sure we remember that, and we need to understand how it works. So let's try to remember that. The first thing we need to remember, that is the month. So here, if we see the number of months available, 12 months. So remember that I don't have to do anything because 12 month available, the full calculation will be there. So when I use the benefit percentage, I just multiply with the car benefit percentage. I really don't have to divide and find the month. On the other hand, Ms. B have 8 months. So here I need to remember what I need to do. I need to divide by 12 and multiply by 8. So we'll have a benefit. So I need to divide by 12 and multiply by 8 because he's liable to pay the tax on benefit only for 8 months, not for 12, because he or she used the car only for 8 months. So you need to write it down. The next one is the CO2 percentage. So if you see 40 gram, and as soon as you see 40, because if it is 40, more likely it will be less electric range. So you can see 40 and 120. Now we can see here 40 is the CO2. So we can see our CO2 is 40. That means it is between 1 to 50. So 40 means is 1 to 50. So it comes under here. And at the same time, electric range is 120. So 120 fall between 70 and 129. So we can easily see it's 6%. So the first one is 6%, is easy. So you see the answer is on the reference material. Even if you don't know it, you know the answer here. The next one is the cost price and the list price. Remember that the cost price is irrelevant. So make sure you cross it. You cross it. You do not need the cost price at all. Cost price is just to make you confused. Do not even look at the cost price. As soon as you see the cost price, remember that, ignore it, ignore it. You need the list price, you need the list price. Then employee contribution to the cost of the car. Remember that employee contribution have a limit that is a maximum 5,000. So here I cannot 6,500. So the maximum is 5,000. That means if it is 4,000, 4,500, I can take. But if it is more than 5,000, I have to stop. I can take maximum 5. That's the limit. This one have no contributions. I'm fine with that. Then employee contribution for Dr. D have nothing, so it's fine. But for the Miss B, we can see 120 per month. Remember that this one will be multiplied with the 8 because it's 8 months. So we'll do that 120 multiplied by 8. So 120 multiplied 8, and that gives me 960. All this information, the workout, if we have with us, our life will be very easy. And then private fuel paid by the employer, no. So this one have no problem. Yes, now this one have a question. Remember that if the private fuel, if we see the private fuel have a percentage, so we need to remember that. So again, we can check our reference material. So let me show you the reference material. So if we click back, so we have a fuel. So we have a car and we have a van and we have other benefit, car benefit, car fuel benefit. So fuel benefit have a fixed percentage that is 28,200. You can see here. So on this 28,200, we need to multiply the car benefit percentage. So this is fixed. So all we have to remember it, or we can always look at the reference material. So all right, so go back, and now one thing we have to remember, the fuel benefit, if the employer contribute for the fuel benefit, here Dr. D said no, so you don't have to worry about anything. We need to check, is employee contributing anything for the fuel? It's very important. Remember that the partial contribution is not accepted. If in the exam, if the question said like, oh, the employee contribute 50 pounds, for example, here, say 50 pounds per month. Remember that is not going to work. Is a useless information. They just want you to get confused. That's why they want to give it to you. So either full benefit or no benefit at all. So either the employee need to contribute the whole amount for the fuel. For example, if the fuel is 100 pounds per month, the employee need to pay all 100 pounds per month. If the employee pay 80 pounds per month and the 20 pounds paid by the employer, then the whole benefit will be calculated. Not only like, oh, the benefit is 28,200 multiplied by the car percentage and then you minus paid by the employee. No, how much is the employee paid? It is not be considered. So we'll not consider how much employee paid. For the fuel, we're not going to consider it. But for the car, yes, use of the car, we need to consider it. For the fuel, either full benefit or either no benefit. Remember that. Either full benefit or no benefit for the fuel. So this is our story. So once we know the story, now we can move on to the main question. So let's move on to the main question now. So we know all this story. We've done our working. So now we'll go back to the question. So we'll see here. So this one is very easy. We already calculated that. So the car benefit, we said Dr. D. So it was 140 CO2 and 120 mileage. So 40 and 120. So that means 6%. So 6%, we already calculate that. So we already know how to calculate that anyway. And the next one we have here, that is the car benefit for the B. Now let's take a look for the B. So B have how many grams? So B have 112. So again, we can do the working. So we have 112. Easy to calculate. For the first 55 is 17. So we do 112 minus 55. And then for every 5, 1% need to be increased. So divide by 5. So let's do that. 112 minus 55 divided by 5. So that is 11.4%. You can take 11 because always need to round it down. And then we add the 17% for the first 55. 17 plus 17. And that gives me 28.4%. Remember that we always round it down. That means 28%. That's it. So we're going to say this is 28%. So 28%. All right, so we've done our first two. Now the next one is asking the taxable benefit provision on the car for D and for B. Now let's calculate the benefit on the car. So let's try to calculate it. Let's do for the Dr. D first. We start with the list price. As I said, we do not consider the cost. So list price. So we say LP list price is 26,200. And then we need to minus the capital contribution. That is, as I said, a maximum of 5,000. So we're going to minus 5,000. So we do 26,200 minus 5,000. And that gives me 21,200. And then we need to use the benefit percentage. Remember the benefit we calculated, 6%. So we need to multiply with 6%. Multiply 6%. And that gives me 1272. Now, this is for the 12 month. I don't have to apportion. And there is no contribution to use the car. I don't have to minus anything else. So we're happy for that. So you will say the taxable benefit for this car, 1272. Simple as this. The next one for the B, you have to be careful because we have two information. One is the 8 month and one is the contribution to use the car. So let's take a look. So we have this one. We do not consider the cost. We consider the list price. So we say LP list price for Ms. B, 36,100. There is no capital contribution, is 0. So we don't have to minus anything. So we just multiply 28%. We say 36,100 multiply 28%. And that gives me 10108. And then what I need to do, I need to apportion it because it's for the 8 month. So I'll do divide by 12, multiply by 8. So let's do divide by 12, multiply by 8. And that gives me 6738. 6738.6. So you can take maybe 39. Even if it is close, you'll get the full marks anyway. So 6738.6. So you can take 39. And then you minus the contribution per month. So 120 multiplied by 8. So 120 multiplied by 8, because to use the car, he's paying 960. 960 he's paying every year. So we'll say now 6739 minus 960. And that gives 5779. 5779. So this is my benefit. So we need to write 5779. And that's it. Remember that this question, working is everything. You need to make sure on the paper you do the working right and you get the answer right as well. All right, the next one is the taxable benefit on the provision on the fuel. The fuel is very straightforward. As I said to you, either full benefit or no benefit. Now here you can see private fuel provided by the employer, no. So if the private fuel is not provided by the employer, there'll be no benefit. So for Dr. D, there'll be no benefit. So that's why it's like the box is closed anyway. You don't have to do anything. For the Ms. B, the answer is yes. The company pay for the petrol as well. but the employee do not make any contribution. So we know very well. So the fuel benefit is the fixed. If you remember how much it is, let's quickly take a look. So we have fuel benefit 28,200. So all you have to do, you have to write it down, 28,200, and multiply with the car benefit percentage. So for Ms. B, the car benefit percentage was 28%. So multiply with the 28%. So 28,200 multiply 28%, and that is 7896. And do not forget it was for 8 months. So divide by 12, multiply by 8. So divide by 12, multiply by 8, and that gives me 5264. 5264. And that's it. 5264. Now remember one thing, in the exam, they're not going to give you that is straightforward. So they will definitely tell you the employee makes some contribution. They will say like, oh, the petrol cost is £100 per month, but employee pay £50 per month. Remember, if they say that, ignore it. And if the question said employee pay full petrol cost, employee pay full fuel cost, remember that if the question said that, then there is no benefit. So either the benefit will be full on this 28,200, the full amount, or there will be no benefit. If the employee paid the full amount for the petrol, no benefit. And if the company paid, then it will be full benefit. There is nothing in the middle. If employee contribute partially, there is no benefit. There is no relief for the partial payment. Remember that. Right, so that's it for our car benefit. So let's take a look. The next one. The next one, it says below is the list benefit of Z Limited provided to his employee. All right. It says L move into a house provided by Z on 1st January 2023. Okay. When its market value 295, the house cost Z Limited 210 on April 15. As soon as you see this date for the house, remember that you need to make a mark 2015 and 2023 when he moved. Now from here to here, we need to check how many years. Remember that if it is more than 6 years, if it's more than 6 years, then we use the market value, not the cost. So 15 to 23 look like more than 6 years, because 15 to 20 is 5 years, 21 is 6 years, so 23 is almost 8 years. So we need to make sure if it is more than 6 years, we do not use the cost, but we use the market value. So here the cost is irrelevant. Not going to consider the cost. We'll consider the market value 295. Then the house has annual value 700, 7,200. So this is important. And the employee pay 500 per month to use the house. So this is the employee contribution. Fair enough. So let's take a look, the annual value. So annual value is 7,200. And remember that the way it is calculated, we need to pick the higher one between the rental value and the annual value. Now this house or this flat is owned by the employer. That's why there is no rental value. But it is possible the company rent out a flat for you and give it to you. In this case, we need to pick the higher one, the rentable amount, how much is the rent company paying per year, and also the annual value. So between these two, you need to pick the higher one. But in this question, the house is owned by the employer. That means there is no rentable value because the company owns this property. That's why only the annual value. Otherwise, you have to pick the higher one between the rent and the annual value. Now, from the annual value, we need to minus how much is the employee contributing. So employee is paying how much? 500 per month. That means 6,000 per year. Now, only the 1,200 I have here. That's the taxable benefit. So this is the easy one. But remember one thing, as I said to you, this house is a luxury house. How do I know it's a luxury house? Let me show you. So the question, the reference material is very helpful, to be honest. If you look at the here, for example, other benefit in kind, if you look at here, expensive accommodation, 75,000. That means if the house limit, if the house have a cost more than 75,000 pounds, it will be treated at luxury house, and there will be additional benefit. Now we need to do some additional calculation. So we need to do 295. As I said, we need to use the market value, not the cost, because it is more than 6 years. So 295 and minus 75,000, and we multiply with the official rate for the HMRC, that is 3.75%. Now, if you do not remember where you can find the official rate, you can just click here and you'll see the official rate should be here. So 3.75. If you forget anything, all the information here, all you have to do, you have to get used to how to use it. So in the exam, you don't look for everything. So now we can see here. So we do 295,000 minus 75,000 multiply 3.75%, and that is give me 8250. So 8250 plus 1200, and that gives me 9450. 9450. So you're going to write here 9450. Remember that if the question said employee just like moving this property in June 2025 or January 2026, we need to make sure we need to only calculate the benefit for how many months he was here. But he moved in 2023, so we are doing the tax calculation for 2025 and 26. So that means in this year, whole time he used the property, so we don't have to really apportion it. Very careful with the date. The next one, it says Mr. V moved to 100 miles due to promotion, received 9,500 to help the removal expense. Now the removal expense have a limit, so let's take a look how much is the other benefit. So other benefit, right? So you can see here we have here removal benefit is 8,000. How much? If you take a look here, 8,000. Removal and relocation expense up to 8,000 is exempted. 8,000 is exempted. So here, how much we have here? You can see here we have 9,500. So we need to just minus it. 9,500 minus 8,000 is exempted. So 1,500. 1,500 will be the BIK, benefit in kind. So we need to declare HMRC through the P11D, like 1,500. I need to pay the tax on. So this one is 8,000, up to 8,000 is exempted, and it is on the reference material. All right, the next one says Mr. Q received an interest-free loan, 16,000 on November 2025. This is the only loan she received, and she has not repaid any loan yet. Now for the loan, we have to do two calculations. We have to do the average method calculation, and we have to do the month-by-month calculation. That is called a strict method, and we have to pick the lower one. So let's try to do both methods. Method number one, we need to do the average method. So average method is how much loan was taken at the beginning of the year and how much loan is remaining outstanding at the end of the year. But this question didn't tell like she repaid any loan back. So that means the whole 16,000 is outstanding. For example, if the question said like 16,000 was taken and after a few months 8,000 paid back, so then it will be 16 plus 8, then divide by 2. But the question didn't say anything about the outstanding amount. I don't know how much is remaining. In the exam, you're not going to find that easy. They will definitely tell you like the loan was 16 and 10 was paid, so here 6 left. So you need to use the average method. So the loan taken at the beginning of the year and how much is outstanding at the end of the year, and then divide by 2. So here I'm going to use only 16,000 because there is no outstanding amount. Whole amount is outstanding, divide by 2 and multiply the official rate 3.75%. So the 16,000 divide by 2 multiply 3.75%, and that's 300. This is my method number one, and then I'm going to use the method number two, that is the month-by-month method. So I took the loan in November, so I have used November, December, January, February, March, 5 months. So I'm going to use 16,000 and multiply 3.75%. So 16,000 multiply 3.75%. So this is 600 for the whole year. And I'm going to divide by 12 and multiply by 5 because I have used this loan only for 5 months. So I'll say divide by 12, multiply by 5, so 250. Now between this 300 and 250, which one is lower? 250. Let's pick the 250 then. I need to pick the lower one. Very careful with that. So both methods you need to calculate. And as I said to you in the exam, they're not going to give you that straightforward. They will tell you that much loan has been repaid. So you have to pick how much loan taken plus how much loan outstanding, then divide by 2, multiply by 3.75%. All right. The next one says, Mr. Yu received a watch for his 30 years long service award. This was Mr. Yu's only long service award, and the watch cost £1,800. So how much will be the taxable benefit here? Now again, this information we can find on our reference material. So let's take a look. So if you look at here, long award. So if you go a little bit down or up, so it will have a non-cash service. Look, non-cash long service award. Non-cash means it's not cash. So watch is a non-cash. So £50 per year. But remember one thing, the long service means it has to be at least 20 years. This is very important. You're not going to find in the AAT book this information, but AAT will ask this question in the exam. So you need to remember that long service means at least 20 years. So that means if someone working only 15 or 19 years, you're not going to get any exemption. So the £50 per year doesn't mean someone worked for 10 years, so you get 500. No, you have to work at least 20 years to treat yourself or consider yourself as a long service award. So here is 30 years, that is more than 20, fine. So for every year is 50. That means for 30 years, you'll be 1,500 exempted. That means the watch value is 1,800, so minus 1,500, so 300 will be taxable. Every year is 50, for 30 years is 1,500, and the watch value is 1,800, so we need to minus 1,500, 300, the employee need to pay tax on. All right, so that's it for our first benefit and kind question. Let's move to the next one. The next one we have here. Okay, let's take a look. All right, so this one is true false question. It said F is a director of F Limited. She received a bonus 2,500 on 30th of April 2025. The bonus was for the counting year ended 31st of March 25. Mrs. F will be taxed on the bonus during the 25 and 26. Now, the bonus one, you need to remember the rules. The rules for the director and the employee is a little bit different. So it's more or less same, but only the difference for the director is there's some additional information. Let's try to understand what is the difference. What does that mean? So if we have, for example, the director, we need to look at when he was entitled or she was entitled, when the bonus was actually paid, and when the bonus was already declared, or if the company already decided the bonus will be given at the end of the year. Remember that it is not important when actual money came to the bank. It is not important. Here, the bonus received on April 25. And April 25, basically the tax year is 25 and 26, because from 6th of April to 5th of April 26 is 25-26. So that means the money received on 30th of April 2025, this means this is the tax year of 25 and 26. But the question is like, this bonus was for the counting year 31st of March 25. That means this bonus was relevant to 24 and 25. So the bonus was confirmed. So she was entitled for the bonus for the last year, 24 and 25, even though she received the money after 1 month, but she need to pay the tax on last year, not like when she received. It's like accrual concept. You cannot just say like, oh, the money is not actually to my account yet, so I'm not going to pay the bonus. No, it doesn't work like that. You need to make sure, you need to check when you was entitled for the bonus, when she was entitled, or when the company declared you're going to get the bonus. If she already confirmed, if she entitled, then regardless the money has been paid to the account or not, she need to pay the tax on that year. So this bonus was relevant to 31st of March 25, and 31st of March 25 means 24-25 tax year. even though she received on 30 April, that is 25-26, but she will not pay the tax 25-26. She need to pay the tax on 24-25 when she was entitled. So it says F will be taxed on 25-26. No, that's not true. That's false. Next one, it says HPLC pays all of its employee £5 per week for working from home, as all the employee now work from home part of the week. The employee will be not taxed in this allowance. That's true. If you look at it, want to take a look, the reference material, we can take a look. If you see on the bottom, so it says here £6 per week. £6 per week is exempted. So he's paying 5. So up to 6 is exempted. So this is true. The next one, it says Mr. Y used his own car for business purpose. His employer paid 40 pence per mile. During 25-26, Mr. Y claimed 50,000 business mile, and Mr. Y has an allowable expense 250. So allowable expense, not the taxable. So we need to check. How we'll check? First, we need to look at our reference material, how much is eligible. So let's look at the mileage allowance. So if you look at here, we'll definitely find the mileage allowance. So let's take a look. Tax rate, residence, car benefit, mileage. So here we can see the mileage allowance is for the first 10,000 miles is 45, and then after 10,000, over 10,000 is 20, 5 pence. Up to this amount is exempted. More, if we receive more than that, we need to pay the tax on. So let's take a look how much he received. So he's allowable for the 15,000 mile for the first 10,000 multiply 45 pence. Remember, this is a set of rules, 10,000, 45 pence. So that means it will be always like same. So minus multiply 45 pence. That means 4,500. It will be always fixed. In the exam, you really don't have to work out by using the calculator because it will be always same. First 10,000, 45 pence. So that means 4,500. And rest of the 5,000 mile is 25 pence is allowable. So 5,000 multiply 0.25 pence. You try to save every single minute if you can, because it will help you to spend some time for the next question. So that is 1,250. So if we added this to 4,500, that gives me 5,750. That will be always like that for 15,000 mileage. So for the 15,000 mileage, I have allowable or exempted is up to 5,750. But how much I'm receiving from the business? 40 pence per mile. So for the 15,000, the company is paying me 40 pence. So I'm saying 15,000 multiplied by 40 pence, that is 6,000. So I'm receiving more. So I need to pay some tax on. So 250, I need to pay the tax. The question is saying 250 is allowable expense. No, it is a taxable benefit. If it is opposite, for example, my exempt amount is 6,000 and company paying me 5,750, then it is allowable expense. But company paying me more, the employer paying me 6,000 and HMRC allowing me 5,750, that means 250 is the taxable benefit, not allowable expense. So this is false. So when you read the question, when you do the working, the way they make the question is look like, oh, 250. So that means it's true because your calculation also show 250. So you feel like, okay, 250 I have calculated, that means it's true. It's not necessary. So read the question carefully. All right. So this is our next question. All right, let's move to the next question then. Next question we have here, that is for the 10 marks. So this task is about income from investment on the property. Okay, fair enough. So here it says, this information below relates to the investment income receiving 25-26 by the two taxpayers. Okay, so we have here Mr. Zaid receive a dividend 10,000, and his other taxable income after personal allowance is total 35,000. The tax payable by Mr. Zaid on this dividend. So how much tax Mr. Zaid need to pay on this dividend? So let's take a look. So normally, remember that dividend have an allowance 500. For the first 500, we do not pay any tax, regardless what type of taxpayer I am. I'm a basic rate taxpayer, I'm a high rate taxpayer, or I'm an additional rate taxpayer. Regardless what type of taxpayer I am, for the first 500 pound is always exempted. So you multiply by 0, you do not pay any tax. So the next information I need to know is important. It says this one. After the personal allowance, the total 35,000 is the other taxable income. So we do not have to minus the personal allowance again. Remember that. If the question already minus the personal allowance, I do not have to do it again. So I need to use this information to find how much is the remaining allowance from the basic band. So if you remember, our basic band is 37,700. If you do not remember, it's still fine. You can always come to the reference material and then you can click here and check the rate and band. You can see we have our basic band that is 37,700 and this is the rate for the dividend. So we can see out of 37,700 already he used 35,000 for other income. I don't know what type of income, but it's other taxable income, the question said, so I believe it is fine. So we have here the remaining 37,700 minus 35,000 should be 2,700. Yes, so 2,700 is the remaining basic band. So that means this band is 8.7%. I have how much left? 2,700. So now I need to know this is my 10,000 dividend income. So this is my 10,000 dividend income. So how much tax I need to pay? So out of this 10,000, the first thing I know, for the first 2,700, I will pay only was that 8.75%. But before doing that, I know one more thing. For the first 500, I don't pay any tax anyway. So this is very important thing to understand. So let's try to understand that. So what some students do, they do here 20 for the basic rate. So for the dividend, what they do here 8.75%. Remember that if you do that, you will have a wrong calculation. It's not the right way. So first we need to make sure we need to split it. So for example, I will have this one 2,700 and then the remaining, so 10,000 minus 2,700, that gives me 7,300. We need to split this one first because this is the total 10,000 here. Now, all you have to do, this 2,700, you have to break it down into two because the first 500 is a tax-free. So we need to say first 500, this one will be 0%. And then 2,200 will be multiplied by 8.75%. So if you do that, so 2,200 multiply 8.75%, that will give me 192 here, 192.5. And then with this one, I'm going to charge the higher rate, that is 33.75%. So then 7,300 multiply 33.75%, and that is 2,463.75. So 192.5. And that gives me 2,656. So remember that that's how we need to do. So it will be 2,6 and 5,6. 2,656. So the common mistake here the student they do 2,700 multiply 2,700 multiplied by 8.75%. Do not do that. First 500 is zero-rated. So always need to make sure, do not give the 500 from here, not from the 7,300. You need to make sure if you have any remaining basic band or any remaining higher band, you have to use the 500 from there, not from the higher rate, from the basic rate. Always remember that. All right, so this is our first one. The next one is said, Miss White received 2,500 interest from her building society. Now interest is a saving income. And for the saving income, if I am a basic rate taxpayer, then I have a 1,000 allowance. If I'm a higher rate taxpayer, I have a 500 allowance. If I'm an additional rate taxpayer, then I don't have any allowance. So you need to make sure you remember the allowance. And 240 interest from an individual saving account. Now IS is exempted. So ISA, individual saving account, is exempted. So cross it. It's not relevant to you. Ignore it. Her other taxable income after the personal allowance 66,000. So as soon as you see 66,000, that means it's more than 50,000 to 50, or more than after personal allowance, that is more than 37,700. So he's a higher rate taxpayer. So if he's a higher rate taxpayer, so the tax rate should be 40%. 40%. So now this one is not relevant to 40. So she received 2,500 interest from the saving account. Miss Y income from the investment on which tax will be paid. Now remember, the question not asking how much tax. The question is asking on which amount the tax needs to be calculated. So what is the taxable amount? What is the taxable income? So on which amount we're going to multiply the tax. So the first 2,500 we have, and we know she is a higher rate taxpayer. So we need to minus 500, the allowance. If she is a basic rate taxpayer, we need to minus 1,000. If she is an additional rate taxpayer, we do not minus anything. So she will be liable to pay tax on this 2,000. So you're going to say 2,000. That's it. We're not going to calculate the tax. The next question is says the total tax payable on this interest. So how much will be the tax? So simple as this, 2,000 multiply 40%. So let's do that. So 2,000 multiplied 40% is 800. So the tax will be 800 pound here. That's it. All right, let's move to the next one. The next one is says Mr. J own and rent out two property during the 25-26. The details regarding the properties are shown within the table below. So this question relevant to the property income. All right, so the first property on Sunny Street, and the next property is on Cloudy Close. So taxable rent and allowable expense, two portion, you need to find it out. Let's do that. Sunny Street was let from 1st of June 2025. So we need to calculate up from June. So June, July, August, September, October, November, December, January, February, March, 10 months. But remember, if the rent is paid on the first day of the month, our tax period is 6th of April 25 to 5th of April 26. So in this period, how much we're going to be receiving? If my income is less than 150,000, remember that. If my income is 150,000 or 150,000 or less, then I use the cash basis. Cash basis. So I do not use the accrual basis. So that means how much actual cash received on the bank. I only consider that, not the accrual basis. So here it says for the remainder of the tax year for 1250 per month, rent is paid on the 1st of every month. That means in this 5th of April, on the first 5 days, I'm going to receive another rent because rent is paid every month first. That means even though 5th of April, my year will be end, but this rent also needs to be considered for the month of April. Mrs. J pay 8% commission on the letting agent. That means so I need to calculate the rent first. So how many months here? So starting from the June. So June, July, August, September, October, November, December, January, February, March. Then we have April because I have a 5th days from April and the rent will be received on 1st. So in April, I'm going to receive the rent as well. So 11 month, how much per month? 1,250 multiply 11. So 1,250 multiply 11. That gives me 13,750. So this is the rent I'm going to declare because this is the cash basis. So do not think like, oh, it's only 10 months because year will be ended 31st of March. No, it's a personal tax. It's not a business tax. When the business tax question you will do, you do not consider the 5 days. But for the personal tax, you need to consider the 5 days as well. So I'm going to write 13,750. How much is the allowable expense? It's 8%. So that will be simple, 8%. 1,100. So 1,100 is the allowable expense, agent commission. The next one says Cloudy Close. Cloudy Close was let from 15 January 2026 for the remainder of the tax year of 420 per month. Rent is paid on the 16th every month. Mrs. J paid 2,100 to repair. So that's fine. So 2,100 for the repair. Remember that repair is allowable expense. but the improvement is not any revenue expenditure. So repair and maintenance is allowable expenditure. But if there is improvement, for example, they made another bathroom or another room or make an extension or any improvement, there is a capital expenditure. Capital expenditure is not allowable expenditure for the property business. But remember one thing, if there is a replacement, for example, they had one sofa before, now they replace it, then it is allowable, but with the same price, not the luxury one, not the expensive one. If they already have the single bed and if they replace with a double bed, so cost for the single bed is allowable but not for the double bed. But remember one thing, this is the exception. If they have a single glass window, but if they make double glass window now, then it is allowable even though there is improvement, because if they spend something to bring the asset to the market standard, for example, everyone using this double glass window but we are the only one using the single glass, in this case I'm bringing the asset to the market standard. So bring the market standard, if I spend any cost, this is allowable even though if it is improvement. Other than only the revenue expenditure like a repair and maintenance, then replacement, it is allowable, not the capital expenditure. All right, so this one 2100 is a repair, so it's definitely allowable expenditure. And this one, it says 424 month from the January. So we receive one salary rent on January. So January, February, and then we have a March. So 3 months. So 420 multiply 3. 420 multiply 3. So 1260. Do not take the April because we're receiving on 15 January. And every time we receive the rent on 16 every month. But our tax year will be ended on 5th. That means after 5th, this belongs to the next tax year. I'm not going to consider that. Remember that. All right, so look like this one is done. So let's move to the next question. The next question we have here again, the true false. Let's quickly do that. So it says, identify whether the following statement true or false. Okay, an additional rate taxpayer will pay tax on dividend 45%. This is true or false, we can find it out. So we can look at here, additional rate. The dividend tax rate is 39.35, but it's additional rate taxpayer will pay dividend tax 45. This is false. Remember that most of the question information you're going to find on the reference material. All you have to do, you have to know how to use it. So make sure you use it. If you don't know anything, check on the reference material. All right, so the next one, it says a landlord replaced an old washing machine with a new improved one. The same model of the old washing machine would have cost 700. The new washing machine costs 900. The landlord can claim 900 as an allowable expense. That's not true. If I can find something on the market for 700, and if I buy the good one or the luxury one, I'm not allowed to claim the full expense. I can only claim the replacement one up to 700. I can claim up to 700 because in the market I can get something for 700. So this is false. So if I spend for the luxury or for the good quality, I cannot claim this expense. I can only claim which one is also available in the market to replace the asset. All right, so let's move to the next one. The next one we have here, task 4. So let's try the task 4. The task 4 is says this asks about the income tax. All right. So income from the employment, then profit from the property, building society, then dividend received, then Mr. O has a loss from the property, so the loss brought forward, so opening year loss coming from the last year. During 25-26, Mr. O paid 6% to the occupational pension scheme. Her employer paid 10%. Okay, Mr. O also paid 150 per month into a private pension scheme and PY. Okay, let's break it down. What we need to know is important. First thing, this one, income from employment, non-saving income. Non-saving income. It's very important to separate it. Profit from property, non-saving income. Building society, saving income. Dividend received, dividend. First, you need to do that. Then loss from the property. So loss brought forward from last year. And during the year, O paid 6% to occupational pension scheme, OPS. OPS. Remember that OPS is straight away minus from the employment income. So how much is the employment income we have here? 85,100. Then we need to multiply with 6%. And then we're going to minus it from the 85,100. OPS is straight away minus from the employment income. Our employer pay 10% to the same, doesn't matter. This information is not relevant to me, how much the company paying, so we don't need it. Then we have 150 PPS or PPC. PPC, we have two impact. PPC will have impact on the ANI, adjusted net income. Also, it will be extend the basic band and the higher band with the gross amount. So 150, if the quotient do not say it is a gross or it is a net, always think it is a net. Unless the quotient mention it is a gross, always think it is a net. So 150 per month, so 150 multiplied 12. So 150 multiplied 12. 1800, this is the net, and I need to gross it up. How we gross it up? Divide by 0.80. So divide 0.8. So 2250. This is the gross. So this one will be minus as a adjusted income because it will help me to get my personal allowance. Also, it will be extended my basic band and the higher band. Now let's do this question. So as I said, I need to split it. So I need to say non-saving, saving, dividend, total. That's how I think is the best way to do. All right. So let's start with the non-saving income. The first one, as I said, we have a non-saving, and then this non-saving, we need to show it. So I have employment income, employment. This is non-saving, 85,100. And from here, I'm going to straight away minus the 6%. So I'll say less OPS. So I'll say 85,100 multiplied 6%, 5106. Let me minus that. This is the first thing we'll do. Minus 85,100. And that gives me 79,994. Then the next one, we have a profit from the property, but we have a loss as well. So it's a property, again non-saving. So we have a profit this year 32,600, and we have opening loss brought forward, less loss BF 14,320. So 32,600 minus 14,320. That gives me 18,280. Again, it is a non-saving. 18,280. All right. Then we have a building society. Building society interest. That is 3,540. This is a savings. So 3540. And then we have a dividend. So dividend, we have a 10,600. That's it. So now we can see here we have this, this, and this. So this one, if we added this two together, 18,280 plus 7,994, that gave me 98,274. And then the other one we have here, that is 3540 and 10,600. That's what we have. Now, as you know, the personal allowance, we always need to minus from the non-saving. Why? Because this is the only income we do not have an allowance. The saving have a allowance, the dividend have a allowance. So we never use the personal allowance from the non-saving or dividend. Always use the personal allowance from the non-saving. But first we need to calculate the personal allowance first. So how are we going to calculate it? Let's try to calculate the personal allowance. Before we do that, we need to make sure, remember that PPC, as we said, it will be extend our basic band, and also it will be have impact on the personal allowance. We have a threshold, how much? 100,000. And let's try to do it. So the first thing, I will say this one, extend the basic band. So the person, I can see how much is the total income. So we can see here 98,274 plus 3540 plus 10,600. So we can see it is 112,414. 414. So what type of taxpayer he is? Is a higher taxpayer, because it is less than 125. So higher rate taxpayer, I'm fine with that. So I really don't have to worry about like the higher rate extension. So only the basic band, I have 37,700, and plus I need to add this one because my PPC or PPS will be extended the basic band. So I'll say 37,700 plus 2250, and that will be 39,950. So 39,950. So this is my new basic band. So on this band, I'm going to calculate the tax 20%. We don't have to do the higher one because his income is not over 125 anyway. All right, this is our first thing. Now let's calculate the personal allowance adjustment. So for the personal allowance, I'm going to use my net income, that is 112. So this is my total income. So I'm going to say my total income was 112,414. This was my total income. And from this total income, what I need to do, I need to adjust the PPC. So how much was the PPC? So normally, as I said to you, like we need to minus the threshold from the total income. But because of the PPC or PPS, private pension scheme or private pension contribution, we need to reduce our income. So we need to reduce. So it's a less PPS or PPC, that is 2250. So let's minus it. So we have 112,414 minus 2250. And that gives me 110,164. 110,164. So this is called ANI, adjusted net income. Remember that I said ANI. So this is my new adjusted net income. And I'm going to minus the threshold for the PA, personal allowance, that is 100,000. So I'm going to minus the 100,000. And this is 10,164. And divide by 2, because for every £2, £1 need to be reduced. So divide by 2. So that is 5082. So my personal allowance will be reduced by 5082. So normally my personal allowance is how much? So my normal personal allowance is 12,570, and I need to minus this one, 5082. So 12,570. So my new personal allowance will be 7,488. That's it. Now we need to do some more calculation to calculate the tax. So to calculate the tax, I need to make sure I use the table. So let's try to clear a little bit here. So we can do the tax calculation here. So remember the basic band, extended. So other than everything is same. Okay, so here when we are now with the tax calculation, the first thing we need to do, we need to minus the personal loss from the non-saving income. So minus 7 488. So you'll do 98,274 and minus personal allowance 7488. That gives me 90,786. This is my non-saving. So non-saving, saving, dividend. Now I have three income. Now let's calculate the tax. So first for the non-saving, let's calculate the tax for the non-saving. For the non-saving, we're going to do split, because for the first basic band is 20% and more than that will be 40%. Remember the new basic band? The new basic band was 39,950. Remember that it is not 37,700 because we extended by the PPC, that is 150, we gross it up, and 2250 we added with the 37,700, and that the new basic band is now 39,950. Up to here it will be 20%. And the rest will be 40%. So minus, so let's see how much it is. So 90,786 minus 39,950. So the rest is 50,836, and that will be 40%. So let's take a look how much it is. So multiply 40%, and that is 20,334, and here 39,950 multiplied 20% is 7,990. All right, so this is done for the non-saving. For the saving is a higher rate taxpayer, so we have a allowance 500. Remember that. So here we need to split 2, always split 2. So for the first 500 will be 0 rated, so no tax, and the remaining, so 3540 minus 500. So remaining will be 3040. Multiply now 40% higher rate. So 3040 multiply 40%. That is 1216. That's it. And the dividend again doesn't matter what type of taxpayer he is. The first 500 is always 0 rated. So split it. So first 500 will be 0 rated, so no tax for that, 0%. So 10,600 minus 500. So the remaining is 10,100. Multiply. The higher rate is 33.75%. It's not 40%. Remember that the dividend rate is different. So multiply 33.75%. How much it is? So 3408.7. So 3409. That's it. Now let's add all this together. So if you add all this together, plus 1216 plus 20334 plus 7990, and that is 32,949. That's the total. And now we need to minus the PAYE. The tax we already paid. So minus 22,500. Minus 22,500. So the tax I need to pay now, 10,449. That's the tax we need to pay. That's it. This is all workings we need to show here. Remember that sometimes some students get confused, like, oh, I'm working as an employee and I do not do tax return. So I just work and I receive the pay slip. And why I need to do this calculation when I do the exam? Remember that if any tax deducted at source, that means if you are just an employee, you do not have to do the tax return. What we're doing here is the self-assessment, the tax return. So you only need to do it if HMRC don't know anything about your other income. For example, the employment income, HMRC already know you are working for a company, for example, Tesco, Sainsbury's, or if you work for Lloyd's. So they already know because the employer already sending the RTI, the real-time information to HMRC every month before they pay you. So HMRC knows about this income, like you are earning how much from company ABC. But let's say if you are a private tutor, if you do some teaching, or if you do some work that HMRC don't know about this income, then you have to do the tax return. Now, you might thinking like, if I do the tax return, I will only do for the income that HMRC don't know. No, you have to do it that time every time. Everything. For example, if you have a income from the private tuition or private teaching, 1,000 or 2,000 pound, so you not only declare 2,000 pound, that time you declare all of your employment income, any other income, even though HMRC already know it, you need to do it again. And that time you need to minus the PAYE tax that you already paid on your P60. Otherwise, you pay double tax. So do not think like, oh, HMRC already know about my employment, so why I'm going to declare again? You have to do it again. That's how it works. But if you are only employee, and if you already paying the tax as employee and you don't have any other income, then you don't have to do the tax return. You just like carry on as employee. You don't need the UTR number. You don't have to do your self-assessment at all. All right, so let's move on to the next one. The next one we have here, that's the national insurance. That's the easy one. So to do the national insurance, you can always use the reference material because you will have an answer from here. So you can see the national insurance contribution. Let's look at the question. So the question said here, Mr. A and Mr. L employed by G Limited. So G Limited is the employer, the company. Miss A gross salary 67,400. Mr. L gross salary 32,780. All right. This is the total class one national insurance contribution payable by A. So how much is the salary for A? 67,000. So the class one, it says below 12,570 is 0, and more than 12,570 but less than 50,270 is 8%. And that means I need to calculate that because the salary is more than 50,270, and if someone have income more than 50,270, then it's 2%. So I need to do two calculation here. First, because my salary is 67,400, so I'm going to minus 50,270, and that is 2%. So let's find it out. So 67,400 minus 50,270, and that is 17,130 multiplied 2%. So multiply 2%. So that gives me 342.6. And then the difference between these two. So 50,270 minus 12,570, and that will be 8%. It's always fixed because that's how the HMRC make the rules. So 50,270 minus 12,570 personal allowance. So 37,700 multiplied by 8%. And that is 3016. So if we add it together, so plus 342.6, and this is 3358, 3358.6. So you can take 3358 or you can make 3359 because they said only the whole pound only. So you can round it up or you can just keep round it down. It's fine. We get the full marks anyway. So 3359. The next one, it says total class one national insurance contribution paid by Mr. L. Mr. L is a 32,780, so it's less than 50,000. So I don't have to do two. Quite simple. So 32,780. And for the first 12,570, I do not pay national insurance. It's free, exempted. So find the difference. And then multiply by 8%. So 32,780 minus 12,570 multiplied 8%. So 16.8, or you can make 16.17. You'll get the full mark anyway. 16.16. The next one is the total employer. This time is a company employer class 1 national insurance contribution paid by G Limited for the salary A and L. So class 1 employer is says below 5,000 is 0, more than 5,000 is 15%. This is quite straightforward. All you have to do, we need to add all the salary of the employee. So you add this to, if you have more employee, you add all the gross salary. So I'll say 67,400 plus 32,780. So we need to add this to, so 67,400 plus 32,780. This is 100,180. Doesn't matter how many employees you have, you added all the gross salary. And then you minus the threshold. Threshold is 5,000 for each employee. Remember that. Do not just minus 5,000 from all the total employee. No, for each employee, for every single employee, the threshold is 5,000. So we have a 2 employee here. So the threshold will be 5,000 multiplied 2. So 10,000 we need to minus. So for the first 10,000, we do not pay any tax. So this one is 90,180. And then we multiply with what percent? 15%. Multiply 15%. Is 13,527. So that will be the last one. 13,527. That's it. Remember one thing, the way HMRC calculate the tax for the whole year, 12,570, this is tax-free amount. So if you have 1 job, 2 job, 3 job, your allowance remains same. So they will added all the income. So let's say if you have 3 job, 3 part-time job, they will added all the 3 part-time job, and they will tell you like, okay, up to 12,570, you do not have to pay the tax. But for the national insurance is different. Remember that if you have a 2 part-time job, for each job, you don't have to pay up to 12,570. So every job, if you have a 2 job, 3 job, every single new job you take, then you have a new allowance for the national insurance. It's not like a tax. All right, the next one we have here, it says, identify whether the following statement are true or false. Mr. T has 2 part-time jobs. One pays 7,500 and other one pays 8,700 per year. Mr. T will no national insurance contribution. So pay no national insurance contribution. That's true. Because for the first job, up to 12,570, again, the another job, 12,570 is not the tax. If he have another job and income is 10,000, he again do not pay national insurance. So every new job allow him for the new allowance. Employer must have more than 10 employees to be entitled to employment allowance. That's not true. Employment allowance is 10,500, and the requirement is you have to have a 2 employee, not 1. So if you are the director of the employee, and if you are the director of the company and you are the only employee, then you are not eligible. If you are a director of the company, you should have at least 1 more employee. So ideally, or generally we can speak, you have to have 2 employees, not 1. If you have 2 employees, you are eligible for the 10,500 allowance, not 10, 2 employees. But if you are director, it's not enough. Remember that. But it will not be asking in the exam anyway, because they will not make it too complicated. This one is very common in the exam. Class 1A is for the benefit. Remember that. Benefit is straight away 15%. So non-cash benefit. This is very common in the exam. Make sure if there is a non-cash benefit, for example, the company give a asset to the employee to use, so it's straight away 15%. So there is no allowance, straight away 15%. All right, so this is our story for this question. So let's move on to the next one. All right, the next one we have here, this is for, again, tax planning. So how we can save some tax. So let's take a look at that. So it says this task is about the tax planning. This task contains part A to B. You work for a firm of accountant and several clients have recently contacted you about ways in which they can minimize their tax liability. Okay. Complete the following statement. So only pounds, so you don't have to enter the pence. In 2025 and 26, Mrs. Z have a sole income 52,500 from the employment, and she want to make a pension payment from the start of the tax year. Mrs. Z want to know if she paying 200 per month into the PPS, that is private pension contribution, would result a lower tax liability than paying 200 in the OPS. So which one is better? This one, the question is the OPS is better to save the tax, or PPS or PPC is better. Now, so far we have discussed this one before. OPS is a straightaway minus from the employment income. On the other hand, the PPS will be helping to extend the basic band. At the same time, also, it will help me to get my personal allowance back. Now, for her, is personal allowance not the issues, because her income is only 52,500, because the income is less than 100,000 anyway, so she have the full personal allowance anyway. So you only need to consider the basic band extended. On the other hand, the PPC, we need to work out both, and we need to say the PPS will give you this tax and the OPS give you this tax. So this one is better, this one is not better. So let's take a look. How can we do that? So to do this question, we have to split. First, we need to split with this one. So the OPS and the PPC. So let's take a look first. So our income, so let's try to write it down here. So PPS and OPS. So the PPS is the personal pension scheme, and the OPS is the occupational pension scheme. So let's take a look. Which one is better? So my income from the employment, the 52,500. And the OPS is straightaway minus the OPS from here. So it says 200 per month. So that means 200 multiplied 12 is 2,400. So minus 2,400 is straightaway from here. So let's calculate that. 52,500 minus 2,400. That gives me 50,000 and 100. So this will be my income on the with the PPC with OPS. So now I'm going to minus the personal allowance. So 12,570 and 12,570, that gives me the income 37,530. So this one is less than 37,700. That means I will still have the full basic band allowance. So it will be 20%. You don't have to split. If it's more than 37,700, make sure you split with the basic and the higher band. So multiply with the 20%, and that gives me 7,506. That will be the tax if I use the OPS, occupational pension scheme. And if I use the PPS, so my income 52,500, and this time I'm not going to deduct the OPS like this, because this one will extend my basic band. So here I'm going to straight away minus the personal allowance 12,570. So 52,500 minus 12,570. That gives me 39,930. Now this one with the PPS is 200 per month. So again 2,400, but this one is net. Remember that if the quotient do not mention even it is a net, remember it is a net. If the quotient said gross, then you don't have to gross it up. But if the quotient say net is net, if the quotient do not mention anything, still it is net. So I need to gross it up by 0.80. So 37,2,400 divide 0.8. That's 3,000. So this 3,000 will be added with my basic band, 37,000. 700. So my new basic band will be 40,700. That's my new basic band. So that means this one, 39,930 is less than 40,700. So I'm still on the basic rate 20%. So let's calculate that. 39930 multiply 20%, and that gives me 7986. So my tax will be 7986 if I use the PPS. And if I use the OPS, my tax will be 7506. So which one is better? This look like the OPS, I'm paying less tax. How much I'm paying less? So let's find the difference. 7506. So 480 pound less tax with OPS. So if I choose the OPS, I pay 480 pound less. So here, the question said how much? So you're going to write 480, and more or less is a then if she pay into the occupational pension scheme. So this one it says 400, and so it says MSZ if she select a private pension scheme. So if you choose the PPS, so the question is saying if she choose the PPS, what will happen? She will pay more. So more than OPS. So because OPS is better, isn't it? Because if she choose the PPS, she will pay 480 more. If she choose OPS, then she will pay 480 less. Because with the OPS tax is 7,506. With the PPS tax is 7,980. That means with the PPS, she will pay more tax. How much? 480. All right. The next one we have here, Mr. X, a high rate taxpayer, has inherited 50,000 and he currently has no investment income and he wants to invest this money into the most tax efficient way. Mr. X has looked into the different investment option and he has decided that he does not want to invest in share. Okay. Mr. X wants to know how much tax he will pay if he decided to invest all the money with his local building society in the most tax efficient way. Most tax efficient way means he can put the money on the ISA. And ISA means 20,000 is exempted. So you don't have to pay tax on the first 20,000. You tell Mr. X that his tax liability on the investment would be how much? So total 50,000 he want to invest, and out of 50, 20,000 will be exempted. So actual investment will be considered 30,000 and 2% will be the return. So 30,000 multiplied 2%. So 600 will be the return. And the question said he's a higher rate taxpayer. That means first 500 is the saving allowance. So for the first 500, he's not going to pay any tax because he's a higher rate taxpayer. So he have a saving allowance 500. So only 100 pound will be the taxable income. And he's a higher rate taxpayer, so you need to pay the tax 40%. So say 40 pound. So you will pay 40 pound of tax. All right, so this one is a bit tricky. Make sure you revise well this one. Okay, let's move to the next one. The next one is says taxable or exempted. So this question is quite straightforward. Either you get the full marks or you will get the 0. So let's take a look. It says if limited want to award someone, okay, some employee with a benefit which are not taxable on the employee. So they want to give some type of benefit that is not taxable for them. So let's take a look. A canteen where all employee can eat for free, that's definitely exempted. Remember that if a company offer the free canteen where all the employee can eat, it will be exempted. But there is a condition. Remember that if the meal is only available for the higher class employee, for example, only the food is free for the managers or supervisors, but all the other employee, the food is not free. Or if they buy the food from outside, do not make inside of the canteen, then it is not exempted. if there is a canteen inside of the company, if they make their own food there, and if they have their kitchen, and if the food is available for all the employee, not for only specific categorized employee, then it is exempted, otherwise not. So the question said, the canteen where all the employee can eat for free, that definitely exempted. A shopping voucher costing the employee 500 for all employee who have worked for more than 10 years. Remember that it is not exempted. Even the shopping voucher is a non-cash, but it is a 10 years. Remember that only the exempted award is started after 20 years of service. So unless someone work with the company at least for 20 years, there is no exempted award. So this is taxable. So to get any sort of award, you need to work at least 20 years with a long service. So it's not exempted, it's taxable. Then availability of a loan, 15,000 to all employee. The loan would be for 5 years and interest charge would be 5%. Now this question could be really, really tricky for some student, because so far on your study material said if the loan is for 10,000, if the loan is for 10,000, then it is exempted. But if the loan is for more than 10,000 for the one period, then it is not exempted, it is taxable. So if you see the 15,000, it's look like, oh, it's taxable because it's more than 10,000, but it is not, because there are some other condition. What is the condition? The condition is the loan would be for 5 years. It's a fixed loan for 5 years, and interest charge would be 5%. So fixed rate of interest. If there is a fixed rate of interest, and if the interest is either the HMRC official rate, that is 3.75% or more. So if the company charge employee interest either 3.75% or more, then there will be no taxable benefit for the employee, so it will be exempted. Remember that. Now, if it is, for example, not 5%, it is 2% or 2.5%, then the difference will be the taxable benefit. But if the company already charging the employee more than 3.75%, that means they're already charging more than the official rate, and that will not create any taxable benefit for the employee, so it will be exempted. Even though it is more than 10,000, still it will be exempted because they are charging for the fixed interest for 5%. This is more than 3.75%. So if the company charges 3.75 or more, it will be exempted. Remember that. All right, so this is done. Let's move to the next one. The next one we have here, task 7, and this is for the capital gain tax. So this one, it will be your another straightforward question. Either you get the full marks or you lose the marks. So let's take a look. All right, so here we can see this question. We have part A to C. Identify whether the following disposal are chargeable to or exempt from the capital gain tax. So the first one, it says a gift of an asset with a market value 15,000 to charity. Any gift to the charity is exempted. As soon as you see there is a gift to the charity, remember that any gift to the charity is exempted. Destruction of a valuable painting caused by fire, it will be chargeable. Remember that even it is destruction by the fire or by flood, for anything, it will be still treated as a dim disposal. Dim disposal. That means that day the fire destroyed the painting. So that day, how much was the value of the painting? It will be treated like it was sold on that day, even though it is destroyed by the fire, even though you did not receive any money from the insurance company, still it will be treated as a disposal. That means you need to pay the tax. So for example, if today the painting is destroyed by fire, we need to appraise how much was the value for the painting today and how much was the cost. We minus the cost and we calculate all the other costs, and any gain we need to pay tax on, even though the painting is destroyed by the fire. even though we did not receive any money from the insurance company. And if we receive the money from the insurance company, then this amount will be treated as a disposal value. Otherwise, we need to find the appraisal value and it will be treated as a deemed disposal. Remember that is destroyed doesn't mean we don't have to pay the tax, we have to pay the tax. Then a chattel with useful life of 40 years is not used for the business. This is also exempted. It is called wasting chattels. So if the chattel have a useful life less than 50 years, we call it wasting chattels, and then this is exempted. If less than 50 years is exempted. All right, let's move to the next one. The next one we have here is the 6,000 pound rules. This one is quite common in the exam as well. So the first one is quite straightforward. The cost is, we have here proceed is 7,200 and the cost is 5,800. So 7,200 minus 5,800, and that gives me 1,400. 1,400, and that's a gain, taxable gain. The next one is the racehorse. Remember that racehorse and the greyhound for the dogs racing, this is exempted. So this one will say exempted. Exempted. Then this one will have 0. Then the mirror, the proceed was 5,500 and the cost is 6,300. Remember, if the proceed is less than 6,000, if the proceed is less than 6,000 and the cost is more than 6,000, then it will be treated as a deemed disposal for 6. Even though it is 5,500, we still need to treat the proceed is 6,000. So we need to minus 6,000, 6,300. We need to minus from 6,000, not from 5,500. It's a 6,000 pound rules. Make sure you always remember it because this one is very important to be in the exam. And if you look at the reference material, if you look at the capital gain tax, so you will have a amount, 3,000 is the exemption amount. Then we'll have a tax rate, 18%. So make sure you look at all this thing for the capital gain tax. It is very common in the exam. All right. So if it is less than 6,000, we treat as a deemed disposal is 6,000. So we need to minus the cost from 6,000. So our loss will be only 300. Then the car, remember that car is exempted. Exempted. So 0. It's car, guild, government, guild, this type of thing is exempted. Gray horse and racehorse is exempted. Make sure you have a list of the exempted. So in the exam, if something you know already exempted, you really don't have to do the calculation. Just quickly says exempted and 0 gain. All right, the next one we have here is says B brought 10 acre of land, 126,000 in December 2000. In April 2025, she sold 10 acre land, 75,000. The remaining acre value this at the time of disposal. So it says how much is the value, how much is the gain. So the proceed, the question already said 75,000. So I'm going to write here 75,000. We need to find the cost. Now to find the cost, we need to use a formula. The total cost of the land was 126,000. And we need to use the formula. So A over A plus B. So A represent the disposal value. So how much you sold it for? 75,000. And then 75,000. And then the remaining value of the land, 175. So let's try to see how much it is here. So 75 plus 175, that gives me 250. So 75,000 divided by 250,000 and then multiply with 126,000. And that gives me 37,800. So the cost is 37,800. And if you minus it, and the gain will be 37,200. This is the formula. Just need to make sure you remember that. All right, so we've done this one. Let's move to the next one. The next one is a share disposal. That's the most easiest question you have. So all you have to do, you have to remember how to do it. And it's quite straightforward because it is not the business tax, so there is no indexation. So all you have to do, you have to find the share pool and you have to see how much is the cost. That's all you have to do. So let's find it out. So we're going to say shares, and then you're going to write the cost, and that's it. So description, and if you want to write the date, you can write the date. The 4 column, you can use this 4 column to write it down here. Okay, so the date we have 4th of April. So for April, how many shares? 800 shares. So this description, you're going to write purchase. Purchase, how many shares? 800 shares. And each share is 1820. So multiply by 18.20. So how much it will be? 8,800 shares multiplied by 18.20. That's 14,560 is the cost. Then 16 September, bonus issue. The bonus issue is the 1 for 5. That means if you have a 5, I'll give you 1. So 1 is 2, 5. This 1 may represent 4. You can write it down 1, 4, 5. That means if you have 5, I'll give you 1. So 1, 4, 5. So I'll give you 1, 4, 5. If you have a 5, I'll give you 1. So that means 800 divided by 5. So 800 divided by 5, that's 160. So my number of share will be increased. Remember that because of the bonus issue, only share increase. There will be no cost because bonus is the free share that we're giving to the existing shareholder so that they will be happy. Sometimes the company do not offer the dividend to the existing shareholder, and for some reason the shareholder can be angry, like why there is no dividend. For that reason, the company offered the free share, like a bonus share, so that the shareholder become happy, like, okay, you didn't give the dividend this year, but at least you give us the bonus share. So the cost remains same. Remember that is a free share, so the people will not pay for that. So 14,560, so it's remains same. Then 9th of May, sold. So disposal, how many shares? 200 shares. So 200 share minus disposal, and how much it is share? 500. So 200 multiply 28. So 5,600. So 200 share multiply 28. 5,600. But we need to do the calculation for the sold. This is our first sold. So let's check. Remember that the question asks for the gain only for the 25, 26. So that means the disposal we are making in 2010, we're not going to find the gain for that. That means the capital gain tax already paid on 2010. We do not have to calculate the gain. Very careful with that. So we only need to calculate the gain for example, for this one. What's that called? 4th of August, because this is the 25 and 26 tax year. We don't have to do for the other one. So we said that's fine. So we need to just find the cost. So 14,560 divided by 960. So that will give me the per share cost multiplied by 200. And that will give me 3033. 3033. So minus that. Now how many share we have now? 760. And then we have the cost remaining 11,527. And then we have a 20 of March, 20 of March, then purchase, but this time the right issue. So 1 for 10. So if you have a 10, I'll give you 1. So divide by 10. So 760 divided by 10. That means 76 share. So we need to do 76. So we need to see how many shares. 760 plus 76. So 836 share. And how much is the per share? So 76 multiply 20 per share. So multiply 20. And that gives me 1520. Okay, so 11,527, 1520. That gives me 13,047. Then on 4th of August, we are selling 350 shares. This is the one we need to calculate the gain. So we need to write 4th of August because this one belongs to this tax year 25-26. So it's a disposal. How many shares are we selling? 350. So minus that. 836 minus 350. That gives me 486. This might carry it forward for the share pool. So carry it forward for the share pool. And how much is the cost? Same thing. So 134.7 divided by 836 multiply 350. That will tell me how much is the cost. So 130.47 divided by number of shares, 386. Multiply how many shares we're selling, 350. So that will give me 5462. 5462. So the cost remaining will be carried forward balance 7585. That's it. Now we need to calculate the gain. We need to calculate the gain separately. Because the question will definitely ask for the gain as well. If you take a look, the question will ask for the gain. So the question asking for calculate the gain. So I need to calculate the gain. So let's calculate the gain. So I sold it 350 share. So 350 share multiplied by 40. So how much I sold it for? 350 multiplied 40. That gives me 14,000. This is my disposal value. How much is the cost? 5462. 5462. And the difference will be the gain. 5462. So 8538. 8538. That's the gain. That's it. This type of question will be marked by the human. So it doesn't matter how you write. If your working is right, you'll get the full marks. So make sure you practice with the format. This is the most easiest question you have. So you'll get easily 12 marks from this question. This is the most easiest one. Sorry, 8 marks. Sorry. So 8 marks you can get in 5 minutes or 6 minutes. This question is quite easy. All right. So let's move to the next one. So the next one will be task 9. So let's take a look at this one. So this one is says for our, again, for the capital gain tax. So it says this task about the capital gain tax relief and exemption. Unused annual exemption amount can be carried back and used in the previous year. That's false. Remember that we have the two types of capital gain tax. The annual exemption, one for the capital gain tax, and one we have for the inheritance tax. Remember that for the inheritance tax, the annual exemption can be 1 year carried forward if we didn't use it. So unused annual exemption can be carried forward, not carried back. Carried forward only for 1 year, 3,000. That is only for the inheritance tax for the lifetime. But on the other hand, for the capital gain tax, this annual exemption 3,000, we cannot carry forward, we cannot carry back. If we cannot use it, it will be wasted like a personal allowance. Remember that the unused capital annual exemption for the capital gain tax cannot be carried back, cannot be carried forward. It will be wasted if we don't use it. Remember that. Do not mix it up with the annual exemption for the capital gain tax and for the inheritance tax. Inheritance tax, annual exemption can be carried forward 1 year if it is unused, but for the capital gain tax, no, you cannot carry forward it. So this is false. The next one is says connected person can transfer unused annual exemption amount between themselves. No, no one can transfer annual exemption, regardless it is a connected person, unconnected person, husband and a wife. No, annual exemption amount cannot be transferred to anyone. A taxpayer can only have one private residence at any one time. That's true. If you have more than one home, you have to decide which one you want to choose as your main residence. You cannot claim the PRR, that is private residence relief, for more than one property. You have to make sure you choose one. If you have more than one home, you have to decide this is my main home and you can claim the relief only on that property. That's true. So an annual exam amount is deducted from the chargeable gain before allowable loss brought forward and deducted. That's true. If we have annual exemption amount, we need to use it first before any loss coming from the last year. So first we have a gain, then we minus the annual exemption, then we set loss from the last year, loss brought forward. We cannot use the previous year loss first, then the annual exemption. No, first annual exemption, then minus the last year loss relief. All right, then we have the next one. The next one we have here is says, Miss M made the following capital gain and losses during the year 25-26. Miss M only other income 25-26 was employment income 45,970. Okay, so chargeable gain, allowable loss, then asset 1, 2, 3, 4. So there is 2 gain, 2 loss. All right. Complete the following statement in respect of Miss M capital gain tax. The total amount that M will pay capital gain tax on after the allowance. Okay, the amount of capital gain tax payable. So how much will be the capital gain tax on which amount we're going to calculate the capital gain tax and how much will be the tax? This is the question. So let's take a look. So we have to add all this chargeable gain. So we add this one, and then minus these 2. So let's do that. 17,400 plus 6,890. So 17,400 plus 6,890. 24,290 minus 3,450 minus 1,890. 3,450 minus 1,890. So that gives me 18,950. And remember to minus 3,000, the annual exemption, AEA. So minus 3,000. And that gives me 15,950. So the first one will be 15,950. On this amount, we need to calculate the tax. Now, how much is the tax? We need to do some workings because she has some other income, 45,000. So 45,970. First, we need to know how much is the personal allowance we minus, and then how much is the basic band remaining. So if you minus 12,570, so 45,570 minus 12,570, so 33,400. So that's her income. So our basic band is 37,700. So how much we have remaining the basic band? Minus 37,700. So we have a basic band remaining 4,300. That means out of this 15,950, we need to split into 2. So the first 4,300 will be the basic rate. That is 18%. And the remaining, so 15,000 950 minus 4,300. Remaining 11,650 will be 24%. So 18 and 24. You can always check. If you like to check the rate, you can always go reference material and you can see the capital gain tax rate 18% for the basic rate, and higher rate is 24%. All right, so let's calculate that. So we have here, so calculate 4,300 multiply 18%, 774, and then 11,650 multiply 24%, 2796. And if we added these two together, 774, that will give me 3570. So here 3570. This will be the total tax need to be paid. All right, so that's it for this one. Let's move to the next one. So you have to remember one thing here. We need to always offset the current year loss before we use the annual exemption. So for 23-24, let's take a look. So my current year gain was 24,800 minus the capital loss. So let's take a look. My gain was 24,800 minus my loss was 32,900. So I have a loss here, 8,100. That's my loss that carried forward. Remember that my annual exemption will be wasted because I don't have any gain after minusing the capital loss. So first current year gain and then current year loss. So we need to first find how much is the gain for the current year. If there is no gain, then we waste our annual exemption. The next year we can see here same thing, 47,200. The current year gain and current year loss 38,100. That gives me 9,100 gain this time because I have a more gain. Now I can use the annual exemption, so minus 3,000. So that gives me 6,100. This is gain. Now I can use any loss I have the previous year. So the previous year I have lost 8,100. So from 8,100, I'm going to use 6,100. So to make it 0, so minus 8,100. So I'll have still 2,000 to carry it forward. So if I minus 8,100 here, it will give me the same thing. So 2,000 I can still carry it forward for the next year. Or you can just make it 0 because we cannot raise the negative number. I'm just showing here. You need to write here 6,100. So you make it 0. This is all your workings because you don't have to show it on the exam. You can do the way you like. So out of 8,100 loss, we use next year 6,100 because 6,100 was the gain for the next year. So still I have 2,000 loss available for the future year. For this year, 25-26, my gain is 44,000. So 44,000 minus the loss this year, 28,650. So my this year gain is 15,350. And then you need to minus the annual exemption, 3,000 minus 3,000, and that gives me 12,350. Now, if you remember, we have 2,000 left. The loss we need to use from here. This is my final loss, so minus 2,000. So 10,350. This is all the workings you need to do on the paper, on the white paper. You don't have to show it. So there is no more loss. Out of 8,100, I use 6,100 in next year and 2,000 in this year. So all losses done. The amount chargeable, if any, capital gain tax will be this one. for this year 25 26 10,350 after minusing the annual exemption and the previous year loss. And any loss relief can be carried forward? No. In this year, the next year, I don't have any loss to carry forward because I have used all the losses. All right, so that's not very difficult. So let's move to the next one. So we will just share. Okay, so let's move on. This is our last question, task number 10, and this is one of the easiest questions to get the full marks 10 out of 10. So let's take a look at this question. It says, like, identify whether the following statement about the inheritance tax true or false. Husband and wife and civil partner are assessed independently for inheritance tax. That's true. Remember that even though the nil rate band is transferred between the husband and wife, and there is no gain and there is no loss between the husband and wife. So for example, if the asset is transferred between husband and wife is exempted, but doesn't mean they will not be treated independently. So they're treated separately. So the husband have the separate nil rate band, the separate resident nil rate band. At the same time, the wife has a separate nil rate band and the resident nil rate band. So they have a lifetime exemption. The husband have a separate lifetime exemption. So they have a 7 years refresh the 325,000. Same for the wife. So they'll be treated independently. But if the husband died, the unused nil rate band will be transferred to the wife and wife to husband. That's the only difference. But they will be treated independently, separately. The 250 small gift exemption is per transfer per tax year. This is also true. Remember that if it is more than 250, then the whole amount is taxable, not only the excess of. For example, if it is 260, then the whole 260 will be taxable, not only the 250 minus 260, not 10. Remember that either full amount or fully exempted. It could be as many person as the donor can give. So he can give 200 people 250 everyone, but it cannot be like more than 250. That's the only condition. And it is a lifetime. Remember, it is not a debt. It is on the lifetime tax pet exempted. Any unused annual exemption can be carried back 1 year. That's not true. Unused can be carried forward, not carried back. It could be carried forward 1 year if it is not used, but cannot be carried back. When one party in a marriage or civil partnership dies, the unused part of the nil rate band may be transferred to the surviving spouse and used against the surviving spouse lifetime transfer. Remember, that's not true. So this is false. So here you need to be very careful when you read this question. When one party in a marriage or civil partnership dies, and the unused part of the nil rate band may be transferred to the surviving spouse and used again the surviving spouse lifetime transfer, not in a lifetime transfer. So the nil rate band is only available on death, not in lifetime. So very careful. Mr. Q wife died in 2020. Her estate on death did not use any of the resident nil rate band. The maximum amount of resident nil rate band could be used against Mr. Q. Death is 350. Now, the resident nil rate band is basically is the lower off between the 150,000 and the state value. 150 or the state value. Now, of course, this question did not mention about the state value at all. So here is 150 for the husband and 150 for the wife. So 150 plus 150. So that means is 300. So 350. So is 175 multiplied 2. So if we look at the reference material, we can check here as well. So let's take a look. The nil rate band. So we have here the inheritance tax exemption. So we have 250, that is, we already know this is the marriage exemption. And then we have the inheritance tax exemption. Then we have the tax rate. So additional nil rate band, this is basically the resident nil rate band, 175. So 175 for husband and 175 for wife. So the question said here, Mr. Q's wife died in 2020. Her estate. Remember, if the question do not mention estate, do not think about the resident nil dead band. Resident nil dead band is only applicable if there is a state. So if the question said estate, then it's a resident nil dead band. This is 175 pound each of them, 175,000. So she never used her estate on that, not used by any of our resident nil dead band. The maximum amount of resident nil dead band that could be used against Mr. Q's estate is 375. This is true. Why? Because 175 for the husband. If the husband is died, it will be automatically transferred to the wife. If the wife is died, it will be automatically transferred to the husband. So any unused resident nil band and the nil band will be transferred to the husband and wife if there is a estate. So this is true. Next one, it says complete the following statement about the inheritance tax. It says Mr. Are made two lifetime transfer in 2025 and 26. The first one is May 2025 for 2,500, and the second one is September 25, 4,000. R had used all her annual exemption from 24-25, so there is nothing to be carried forward. The amount of annual exemption that would be set against September 25 lifetime transfer, how much it will be. So we need to check. So let's say we need to do the calculation. So let's do that. So we have one in 2025. So there is two gift here. So the first one was May 25. That belongs to tax year 25, 26. And September, this is also belongs to 25, 26. There is nothing from the last year. So we have these two lifetime gifts, so 4,000 and 2,500. The total lifetime transfer, the question did not mention about, is it for what? Is it for the marriage? Is it for, so we don't know the exemption. So 4,000 plus 2,500. And then we use 6,500 is the total. So annual exemption for the 24-25. So this one, 3,000 annual exemption for the last year. So 24-25 as carried forward. And for this year, 25 and 26. So the remaining 500. So now we need the adjustment for that. So let's do the adjustment. The question clearly said for 24-25 is not available because this one is already used. So only have 3,000 for this year. So we have a two gift here. So May and the September. So when I make the gift for May, 2,500 pound, I already use my annual exemption, 2,500. So that means out of 3,000, 2,500 is gone. So I have only 500 left. For the next one, the gift I make 4,000. So from the 4,000, I can only use 500. So the 3,500 will be PET, potential exempt transfer. So this is the 500 I can only use for the next transfer. So 500. The 500 I can only use for the transfer. Okay. Because for the whole year is 3,000. And the question said, like, I have used the last year one, so I don't have anything left for this year, so I cannot use it. So only 500 I have for the next gift. So 3,000 for 1 year, and we have used 2,500 for the first gift. For the next gift, only 500 available here. Okay. The next one is says, Mr. P received 7,500 from his grandfather on the occasion of his marriage. The maximum amount of transfer that may be liable to inheritance tax when the grandfather dies, that will be 5,000. Why? Because 2,500 is the exempted. Remember that. So when we have a marriage lifetime transfer gift, when the father to the son is 5,000, and the grandfather to the grandchildren, I mean, like for the gift from the grandfather, then is 2,500, and for other is 1,000. You can take a look on the reference material. So if we take a look, inheritance tax. So marriage or civil partnership from the parent is 5,000, grandparents is 2,500, and to other is 1,000, and one party to another is 2,500. That means if Mr. P receives 7,500, 2,500 will be exempted because it's from the grandparents. Rest of the 5,000 will be taxable if the person died. Miss T made a lifetime transfer in January 2021, which has treated as being potential exempt transfer. So when he gave the gift, it was treated as a pet. Miss T died August 25. The taper relief. Taper relief, if someone is alive at least for 3 years, then after 3 years, every 1 year get 20%. So if more than 3, less than 4 is 20%, more than 4, less than 5 is 40%, more than 5, less than 6 is 40%. That's how it works. So you can again check the reference material. So taper relief, let's take a look. So taper relief, you can see here. So how many percentage? You can check the answer from here. So dice in January 21 and August. So let's check from August to January how many years he was alive. So we have so January 21. So then January 22, January 23, 24, and 25. And then before January 26, he died. So that means 4 years. So over 4 years, but less than 5 years. So this one, over 4 years, but less than 5 years. So 40%. You can see the answer is on the reference material. So many questions, you will find the answer on the reference material. So it's easy for you to calculate. All right, the next one is says which one is exempted, which one is CLT, and which one is ET, or which one is PET. PET means, remember that, PET means like any gift you make during the lifetime is paid if it is within 7 years less than 325,000. Any gift you give to anyone is a PET, potentially exempt transfer. Why potential? Because the person could die and the tax could raise. That's why we call it potential, because we are not sure the person will survive 7 years or not. If someone give a gift to someone and if the person is alive for 7 years, there will be no tax at all. So that's why we call it PET, is potential. Maybe the person will be alive or the person will die. If the person do not die, then within 7 years, there is no tax, is exempted completely. If the person die within 7 years, then we need to say after how many years? After 3 years, 4 years, 5 years, then get some taper relief. The ET is exempted. That means there will be no tax at all. Is exempted like a charity. If you give to the political party, is like kind of exempted. On the other hand, there's a CLT. This is only for the trust. If you give your money to the trust or asset, that create the CLT, that is lifetime transfer. So chargeable lifetime transfer, this one, immediate tax, either the donor pay or the donee pay. If the donor pay is 25%, if donee pay 20%. All right, so let's take a look. The first one is cash guilt. Cash guilt is ET. Remember that is exempted. Cash guilt, then obviously the charity, political party, there's a list. Make sure you remember that is exempted. There will be one question in the exam for exempted. So there's only 5 of them. So you need to make sure you write it down, which 5 are exempted. The jewelry, definitely PET is potential exempt transfer. The trust, the CLT is only trust. CLT is only trust, easy to remember. And if you remember the CLT, the trust, and if you remember the exempted one, like the 4 or 5, and the rest is always PET. So PET is like, if something is not CLT, not ET, that means it's PET. All right, so this is the end of the question. You see, like that's how you can complete this question. Hopefully now you understand everything. If you have any question, feel free to send me an email, or you can write on the comment as well. So I'll try to help you if I can, but this exam is not very difficult. All you have to do, you have to make sure you get used to practice and just get used to with the reference material, because this is very, very useful. So that's how you can practice few times this question and make yourself like ready for the exam. Personal tax is quite a straightforward exam. It is not difficult at all. There is only few topic. Make sure you practice chapter number 3, that is the employment income. This one have like benefit in kind. So just like make sure you get used to it. Then other than rest of the chapter is not very difficult at all. So if you practice, you can score 90 to 95% easily on the personal tax account. Thank you very much.